Great. So welcome everyone, and thank you for coming along today. My name is Pagan Aspinall. I'll be facilitating today's session. So just to give an overview of what you can expect, I'll start off by talking a bit about the programme and some of the benefits before I'll pass it on to our academic director, Ken Okamura, who's going to be talking about how AI stocks are being valued. So just a few housekeeping points. If you have any questions that come up throughout the session, please do put them in the Q&A function. If you have any comments like issues with audio, please put them in the chat function and we'll try and get to those. Okay, so the Executive Diploma in Financial Strategy was created off the back of our very successful Executive MBA programme that we have here at Said Business School at the University of Oxford. So the Executive MBA programme, it's a 2-year programme. I think there's about 18 modules, so it's quite a big time commitment. So what the school decided to do, I think about 10 or so years ago, was to take areas that you learn about in the Executive MBA, like financial strategy, and turn them into its own standalone programme for those people who just want to deep dive into one area of business or can't commit to the full Executive MBA programme. So that's how our diploma was created. This Executive Diploma, it's 1 year long and it is part-time. So what happens if you join us is you will come to Oxford 4 times throughout that year. And each time you will study one of our modules, and that will take place over 4 days. So like I said, it's modelled off our Executive MBA programme. So it is a master's level qualification. It is accredited. It's a recognised degree from the University of Oxford. And the exact qualification that you receive on your certificate is a postgraduate diploma. So just to talk a little bit about the teaching style, our programme is extremely practical. So all of you who end up joining us will be in full-time employment. So the idea is that what you learn on the programme, you can take that knowledge and apply it straight away to your individual jobs. So it's a very applied programme. We also have a big focus on classroom discussion. So this is not your typical stuffy old school lecture where there's a professor at the front of the class talking at you all day long. Obviously our sessions, there will be a professor who leads the discussion, but you're very much encouraged to pitch in your own thoughts and talk about your own experiences within your own business. So you really learn from each other just as much as you learn from the professor. And of course, it's the University of Oxford, so it is academically rigorous. So, do expect to be challenged intellectually. We have 1 intake every year. So this is always in January, and it's not too late to apply for our 2024 class. So, hopefully you'll be able to join us. And if so, the start date is the 17th of January. And the course fee is just over £30,000. So in the interest of time, I'm not going to delve too deep into the curriculum, but I thought it would be helpful to see the programme at a glance. So like I said, there's 4 modules. There's strategy, business finance, corporate valuation, and financial strategies for growth. Roughly each module is, per quarter throughout the year. And following each module, there'll be some form of assessment. So whether that's a written assignment or an exam. And then at the end of the programme, you will be expected to do a 6,000 word project on a particular problem or conundrum that you're facing in your business, or it can be from another business or sector. And you take what you've learned in the previous 4 modules and apply it to how you would fix this problem, essentially. And then following that, you will have your graduation ceremony in the Sheldonian Theatre, which is, if you've never been to Oxford before, it's an exceptional historic building. It's where all Oxford students graduate. So it really is a unique opportunity, to have your friends and family watch you graduate in that special atmosphere. So at the start of the session, I asked you to all put in the chat where you're coming from. And as you can see, we had people from all over the globe, and that's really representative of what you can expect from being in our class. So the figures that you see on the screen now, this represents our class in 2023. Every continent was represented, minus Antarctica. But as you can see, it's a wide mix of people, and there were actually 30 different nationalities represented last year alone. So it is very diverse. In terms of age, so the average age is 40, but we have a wide range of ages, anywhere from about 30 up to 60. So, there's absolutely no age restrictions or anything. Leading on from that, we're not just diverse in terms of backgrounds of students, but people do come from quite diverse areas of business. So the programme does attract a number of finance professionals from financial services, but we also have a large portion of the class come from oil and gas, engineering, consultancy, manufacturing. We even had somebody last year from Ralph Lauren, or Ralph Lauren, I never know what the correct way to pronounce that is. So, really it does apply to any area of business. You can get benefits, whatever organisation you come from. And as you can see, we have a number, I've put various job titles of current previous students that we've had. So, we have people who are CEOs, founders, CFOs, but also people a bit more junior in their career who have just started off, sort of more junior sort of manager level. So it really is a big mix. Right, I'm just conscious of the time, so I'll just quickly talk about the alumni network. So upon completion of this programme, you will be invited to join the Oxford Business Alumni Network, which has over 26,000 members. It's important for me to say this is not just alumni who attended Said Business School. This is anyone from the University of Oxford in any subject area who now works in business is part of this network. And there's over 20 regional chapters all throughout the world, from local areas like London, right up to Sydney and Melbourne. So most areas of the world are represented. And your regional chapter will invite you to various events throughout the year. So, anything from casual drinks and get-togethers to formal black tie events. And it's just a really great opportunity for you to meet and connect with other business professionals in your region who, also went to Oxford, and you can reminisce about the good old days back at Oxford. Right, so that's enough from me. I'm going to just change my slides quickly and hand it over to Ken. Just give me one moment. So, should be able to, oh, no, sorry. Right, can we all see that? Perfect. Okay, so I'll hand it over to Ken now.
Great, thank you. Good afternoon, everyone. Thank you for attending. I thought I'd talk a little bit about kind of AI-related stocks. So I've drawn a little bit from strategy, a little bit from finance, a little bit from corporate valuation to talk about how should we look at these things. Okay, so next slide, please. So with every kind of boom, you have winners and you have long-term losers. So at the beginning of every boom, there are a whole load of potential kind of players out there. Many of the share prices go up, and then eventually it becomes clear that some of them aren't going to do as well. So back in the days of taped video recorders, the winner was JVC, the Japan Victor Corporation, who came up with the VHS videotapes. And Sony and Philips had competing systems. Back in the first internet boom, you had Amazon as a winner. There was a company called Webvan that was run by one of the top guys from General Electric, GE Corporation, that went on to fail. We all remember, we all use Google, but on the other hand, there were a whole load of other search engines right at the beginning. And in social media, I'm guessing that some people will still have a MySpace page, but the reality is that a lot of these things have gone. Okay, so how should we think about these things? Next slide, please. So basically, we're going to talk about Nvidia today. And Nvidia actually was a winner of a previous boom, which is to say the rise of 3D computing graphics. So there was a leader, Silicon Graphics, SGI. You might remember that they were the people who actually put together the velociraptors in Jurassic Park. They went bust in 2006. 3DFX was an industry leader in GPUs. They produced an industry standard motherboard. They went bust in 2000. Intel, big players in CPUs, etc. They actually did make multiple attempts to get into the graphics processing units, and they effectively pulled out of GPUs in 2009. So Nvidia came out as the winners. Next slide, please. Next slide, please.
Sorry, seems to be having oh, there we go.
Okay, so when we look at the share price and the performance of various things, back in kind of 2004, when Google was first listed, it had a price earnings ratio of over 200 times, which is to say that their earnings were very low, but the price was very high. Next slide, please. On the other hand, you can see that back in 2004, their share price was quite low, and it actually kind of rose dramatically afterwards. So stock markets are designed to basically discount future performance, which is the reason why shares are actually kind of trading at quite high multiples early on, because they're discounting future growth. Next slide, please. So the price earnings ratio, the first graph of Google I showed you, shows net profits per share divided by the share price. Or actually, technically, I've inverted that. That should actually read the share price divided by net profits per share. And so that is the number of years of earnings that you would need to get to justify the current share price. So a high price earnings ratio means lots of future growth. Now, next slide, please. If we look at Nvidia's price earnings ratio, you can see that back when they were first on the market, they were trading at a very high multiple because, as I said, there was a previous boom. And the shares were trading at 100 times earnings. And then gradually, the market matures and they start trading on between 10 and 20 times earnings. And then during the pandemic, gaming boomed, their share price went up. And in the last year or so, the share price has boomed dramatically as a result of the performance of generative AI, where Nvidia is an enormous player. And so once again, you have a situation where the stock price is discounting a lot of growth. Next slide. please. So this is the same chart as the one that you saw previously, except for the fact I've logged the y-axis so that you can see that it moves between a price earnings ratio of 100 times and 10 times between 2000 and 2009. They're loss making in 2010. Anyway, that's just to make it easier for people to see. So next slide, please. Okay, so here's some basic financial data on Nvidia. As of the close yesterday, the share price was just under $490, and the total market capitalization, the value of the company, was $1.2 trillion. They have negative net debt of about 5 billion, which is to say they have a little bit of cash. But to be perfectly honest, we can think of this as primarily just an all equity finance company. So the enterprise value is 1.2 trillion, and that is an enormous multiple of the book capital, which is the amount of capital that's actually on the balance sheet. And over the last kind of 12 months, they have earned $4, which means the price earnings ratio is 118 times. So obviously, they're discounting a lot of future growth. Next slide, please. So first thing we can do is we can try and work out what the present value of growth opportunities is. And so what we're going to do is we're going to look at the share price, and then look at the earnings per share divided by the cost of equity, which is the current value of the earnings, plus the present value of future growth opportunities. One of the things that we teach you is how to do all these calculations on the diploma. And so what's the cost of equity? We're going to use the capital asset pricing model. I estimate that the risk-free rate is 4.5%, and the market risk premium is just under 4.4%. We need to come up with a beta estimate. There's a question mark here. So if you look at the 5-year beta, it's 1.7. Over 1 year, it's 4.5. I've put in a beta of 3 at the moment. The 5-year beta, unlikely to be right. Fundamentally, people have massively kind of changed their assumptions about the growth rate of Nvidia. On the other hand, that kind of 4.5 for over 1 year is perhaps a little steep. So I've gone for something in the middle. So we can see the cost of equity is about just under 18%, which sounds really high, but on the other hand, the assumption is that people are going to get quite high returns from investing in Nvidia. Okay, next slide, please. So the present value of future growth opportunities, given the share price of $490, is $465, which is to say 95% of the total share price is future growth. Next slide. So here's another way of doing it, the calculation, which is the share price is equal to the current dividends divided by the cost of equity minus the growth rate. And what we're going to try and work out, given the fact we know the share price, we know dividends, we know what the cost of equity is what do we actually think the growth rate of dividends is. And it turns out that the growth rate is roughly the same as the cost of equity, which is to say that the current dividends are incredibly small, and this particular model isn't telling us a huge amount. Okay, next slide. So now we're going to come up with a kind of discounted cash flow model. So this is the workhorse model that we would use in most kind of finance classes. So the enterprise value of the company is equal to their future free cash flows divided by the cost of capital. The free cash flow we're going to assume is net operating profit after tax. We're going to assume a 3% growth, so growing perpetuity. We know what the enterprise value is, 1.2 trillion. we don't know what the free cash flow is, but we have a cost of capital, we have a growth rate. And so this says that the free cash flow that we're currently discounting is about 177 billion. A lot of the AI returns are going to be in the future, so the actual number is slightly higher. What do I mean by that? Next slide, please. That should be 177 billion. The current free cash flow for the last 12 months is 10 billion. And their total revenues are just under 33 billion. So their operating margin is 33%. It's possible that this number is too low because over the next few years, it looks like Nvidia will be selling many, many more kind of software, a lot more in the way of software sales. Profit margins will be slightly higher on that, but nonetheless, to get the 177 billion of free cash flow, they're going to need annual sales of about 536 billion. And if the perpetuity starts in 7 years, the free cash flow needs to be up about 400 billion. The sales revenue will need to be 1.2 trillion, which is kind of high. So next slide, please. So how realistic is that 536 billion in sales? So if you look at all the kind of big multinationals, Amazon has more than that in sales, but their margins are only about 10%. Apple has sales of 380 billion. Their margins are actually pretty good. And then you can see that all companies selling 350 billion, Microsoft selling quite a lot. Alibaba surprisingly has quite low revenues. Of course, they're basically a marketplace. If we compare it to GDP, US GDP is just under 30 trillion. It's value added rather than kind of revenues. So you need to compare it to the free cash flow, 177 billion. So Nvidia would be generating 0.7% of US GDP. That's a lot, but it's not impossible. And global GDP is about 100 trillion. So yeah, it's not impossible, but it's a fairly heroic thing. So we're assuming that Nvidia is going to become really big. Next slide, please. So how should we be thinking about these things? AI demand. So AI-based technology is expected to grow a lot. We know that it's grown a great deal over the last 6 years. So McKinsey, for example, reckons that 50 to 60% of firms are using AI, and it was about 20% back in 2017. 63% of firms estimate that their spending on AI is going to increase. Gartner, looking further ahead, says that 80% of firms will have used generative AI. So that's basically GPT versus about 5% today. And they expect 70% of independent software vendors will incorporate some form of generative AI versus 1% today, which means there's going to be an enormous growth in demand for generative AI. And the point about Nvidia is they are the primary providers of the chips that support the infrastructure for generative AI. Next slide, please. And we're actually already seeing this at the moment, which is that their data center sales in Q2 of 2023 basically had doubled up to $10 billion. And their gaming sales rose by 22% in Q2. It's true that there was a bit of a drop off in gaming in 2022 because post-pandemic people moved away from these things. So what are they actually selling? They're selling kind of highly complex chips. So the point about graphics processing units is that they are much more computationally intensive than the central processing units that you have running in a standard computer, and GPUs were a growth business as a result of the increasing use of computer graphics, and the one of the points is that it turns out that GPUs are incredibly helpful. So during the lull, during kind of 2016, 2017, one of the things that they were doing was Nvidia was selling a lot of GPUs to companies who were doing crypto mining. And now, in the last year, they've been selling an enormous number of chips for people wanting to do generative AI. So they're we're now talking about computers that do exaflops. So I remember when teraflops and petaflops were a big thing, but it's now an exaflop, which is 10 to the 18 floating point operations. That's a billion times a billion. So if you had a billion people with a billion calculators each, they would be if they all press the button simultaneously, that is a single exaflop. So Nvidia is a major supplier to all the big cloud, for all the big kind of cloud providers for large language models, LLMs. So Nvidia is huge in the infrastructure space. Okay, next slide, please. So what does Nvidia do? So they design chips and they're fabless, which is to say they don't do the production themselves. So they're actually outsourcing the production. They are a market leader in the design process, which is to say emulation, simulation testing. They have a single kind of architecture and a very, very large installed base, which means that people don't want to move on from using Nvidia's GPUs. They're also increasingly a provider of infrastructure because they're taking their own chips and putting together computers that work in data centers, and then they're providing this via the cloud services of Microsoft, Meta, and Google. They're also getting into the provision of software and platforms. So remember I said that there was a possibility that the profit margins would be higher. With software and platforms, it's possible that my numbers are slightly off because, in fact, they're going to have much higher profit margins. In this particular case, they have the Nvidia AI for Enterprise and the Omniverse, which is a 3D simulation platform for developers. Nvidia is big in this space. Next slide, please. How big are they? So this slide is taken from Nvidia's kind of last presentation, but they reckon that the kind of total market is worth $1 trillion. So they think the gaming market will be worth 100 billion. Their enterprise software will be worth 150 billion. The Omniverse enterprise software, the 3D simulation stuff, another 150 billion. Chips and systems will be worth 300 billion. So that's basically the backbone to generative AI. They actually think that automotive sales associated with self-driving cars will be worth 300 billion. So you can see that the numbers that they're foreseeing, they're not they're kind of they're in the right kind of ballpark. Next slide, please. Unfortunately, of course, there are also threats. So this is taken from this morning's FT, but Microsoft has launched its own AI chip. Tesla is talking about producing its own, and Intel, AMD have kind of chips. There are kind of other issues out there. Okay, next slide, please. So how should we think about these threats? So now we're into kind of the stuff that my colleagues on the strategy side teach, which is how do we actually think about the competitive position of various different firms? And in this particular case, I think it's kind of interesting to fall back on Jay Barney's resource-based view, which is the idea that any firm is competitive or has a competitive advantage because it has substantial internal resources to organize the firm. And so these internal resources will be valuable because they will enhance the competitive position. They will be rare, which is to say that they will be unusual. They will be imperfectly imitable, which is to say that other companies shouldn't be able to easily copy them, and they shouldn't be substitutable with alternatives. So this is called the resource-based view, the RBV view, and this is VRIN, the VRIN criteria of the resource-based view. So what do we think about kind of the position of what do we think about the position of Nvidia? Next slide, please. So if we go back to how they won back in the first round of graphics processing, they actually pursued the gamer enthusiast market, which 3DFX didn't. They focused solely on GPUs. So Intel was interested, but they were too busy working on CPUs. They pursued the Microsoft Windows PC market. Silicon Graphics kept doing workstations, and they used the kind of Microsoft industry standard DirectX rather than pursuing their own kind of in-house thing. So of these things, most of these things are not VRIN, which is to say they're not, I mean, clearly they had a clearer view of these things, of where the market was going. What they were really good at, and what actually turned out to be a rare, inimitable skill set, was they actually focused on faster chip cycles. So the industry standard for the creation of new chips is 18 to 24 months. And Nvidia actually created chip cycles of between 6 and 12 months. So they had 3 teams working on 3 different generations, and they would iteratively improve. And as a result, the gamer enthusiasts were very keen on Nvidia chips because they were constantly at the cutting edge. Whereas Intel, they were unable to shift up the rate at which they launched new products. And so it is this faster chip cycle thing that actually allowed them to win. Next slide, please. So what is it that they have nowadays that would classify them as being VRIN or advantageous from a resource-based view? Basically, they have the industry's top design team for GPUs, and they have a really solid track record of providing faster chips more quickly than their competitors. They're really good at preventing problems in fabless production, and they've been very, very good at the use of simulation designs. Because they have this enormous advantage in GPUs, they're basically now able to provide the cloud and infrastructure and the platforms that power generative AI. So they're in a very, very strong position. They're also incredibly embedded in the ecosystem for generative AI, because they're doing deals with almost all of the big cloud providers, and they're providing a lot of the backbone for everyone who's producing applications. And as I said before, they have 4 million people, developers using their CUDA architecture, which means that they're very, very deeply embedded. So they have a lot of advantages. Next slide, please. Question is, of course, could others usurp them? This is an interesting question. So ARM, when it listed, was talking about its positioning in generative AI and AI in general. And it is true that there are a lot of new ARM-based chipsets, potentially in mobiles, but also for CPUs, eat into some of the market for chipsets for generative AI. However, at the moment, there is a reason why Nvidia is doing so well, which is they are unchallenged at the top end of the market. In general, there's a perception that ARM-based chipsets are really at the kind of simpler end. But, you know, there is a $300 billion kind of market for automobile kind of chips. And that's an area where, for example, ARM might be better. It's also true that there's a whole load of other companies that are trying to produce their own high-performance GPUs. But up until now, Nvidia's been top of the heap for many, many years. What used to be one of their major kind of competitors, Intel, is even having problems in its main CPU business. So it's not necessarily clear that Nvidia is going to find themselves threatened. Next slide, please. What about the potential for disruptive innovation? You can bring up the one possibility in terms of disruption is the possibility of quantum computing. So quantum computing is not conventional computing, and it will allow far faster calculations on a much, much more kind of impressive scale than even the fastest GPU offered by Nvidia. The reason why they're far faster is because qubits, which are the quantum bits, can be both zeros and ones simultaneously, whereas normally the transistors that go into a standard computer has to be set at either the 0 or the 1 position, which means that the quantum computing, potentially it could be far faster than conventional computers. However, it is still in the very early stages because it turns out to be quite difficult to program quantum computers. But this is one of those things that in 5 or 6 years, when we're expecting generative AI to kind of grow, it's possible that maybe from left field somewhere, someone is going to have an amazing kind of growth story in quantum computing that will fundamentally kind of cut out a lot of the existing players. And this happens again and again. And certainly Nvidia did this to silicon graphics back in the early 90s. So Nvidia obviously knows all this, so they are thinking about this. Clearly, they're not trying to get into the actual business of quantum computing, but they're offering a platform that allows the integration of quantum computing and traditional computers, so that they can stay abreast of the developments. But fundamentally, there are always problems when a company tries to kind of absorb the effects of disruptive innovation. So this is one of the things that people will have to bear in mind when looking at the growth of generative AI. Next slide, please. So there's also the possibility that generative AI could slow down. So basically, to justify the current share price, Nvidia requires sales to grow at 100% a year for 4 years, or in the high double digits over 7 to 10 years. And at the moment, things are going great guns. Everyone is very, very interested in generative AI. Essentially, there is a shortage of Nvidia chips across the board, and they're able to sell their software services, their CPUs, their GPUs at extremely high prices. However, what happens if generative AI doesn't grow as much, and AI in general doesn't grow as much as people expect? So there could be bottlenecks. So, for example, there's a lack of engineers and programmers. There's a lack of fab capacity. So TSMC, which is the fabricator of semiconductors based out of Taiwan, lacks capacity. Now they're building it, but it's possible that there will be kind of bottlenecks. It's also true that at the moment, there are a lot of companies undertaking generative AI, and a lot of it is experimentation. They're all trying to work out where it's going to go. And maybe it's going to turn out to be more difficult to implement than we currently imagine, in which case, maybe the breakneck speed of growth is going to slow down at some point. Difficult to say. Because it's also true that we know that there have been kind of quite significant gains and cost savings as a result of the use of AI already, and this is likely to kind of increase. The final kind of unknown here is the impact of regulation. It's more than possible that regulators will tend to will actually kind of enforce the use of generative AI for governance and for monitoring purposes. But it's also possible that there will be kind of attempts to control excessive use of generative AI for ethics reasons, or because people will be worried about negative effects from allowing computers without human oversight to run things. And so regulation, some bits will accelerate the use of AI. It's also possible that some areas will see it slow down. So this is a kind of short run through of the types of ways in which we can think about how to value an AI stock. It's a big boom. So I noticed that I have a question from Matthew. So how do valuation criteria change if you're trying to value an early stage AI business? The answer is, in general, what we would do is for very early stage stuff, you might end up using the venture capital method. So the methods that I just showed you work much better for they work much better for firms that are established, where we can work out what the cash flows look like. So the venture capital method, basically, you put together some numbers, work out what the profits will be in 5 years' time. That's all made up. And then you apply a industry multiple. So probably kind of, I don't know, 30, 40 times, and then discount that back at a kind of a very, very high discount rate to reflect the uncertainty involved in early stage AI. And so we will be talking about, I don't know, a discount rate of 70% a year. So even if something appears to be worth several hundred million, if you discount that back at 70% a year over 5 years, the current valuation will be a few million. Are there any other questions?
I know, Martin, you put up your hand earlier, so I don't know if you want to type out your question. Although it looks like there's a question now.
So, Anna, I think that once you are signed up and you've been admitted, we do have a Canvas site for people that will be opened up that will allow you to prepare your readings, etc.
I think it's about 6 weeks before the program that's usually released. Yeah, question from Victor.
So Victor, I'm assuming when you say fundamental versus technical, I think you mean kind of looking at the share price movements. So in general, the finance academics are not that keen on technical analysis, which is to say that we don't think that you should be looking at the share price performance. We tend to be much more driven by fundamental analysis, which is to say that we look at the cash flows, the dividends, the expected growth rates, etc. That said, I have friends who run hedge funds who are very keen on technical analysis, which is looking at the kind of share price movements. In general, the rule there is that if we believe lots of other people are looking at technical analysis, if you believe in something fundamentally, it can be helpful for telling you when you should actually undertake a trade, because if everyone is doing the same thing, then you will actually be able to time transactions in this fashion.
Great. Thank you, Ken. I think there is some more questions coming in, but I'm just conscious of the time, and I just wanted to run through some slides at the end about the application process. So if you wouldn't mind typing out responses, what I'll do is I'll just share my screen once more. So hopefully you can all see that. So yeah, thank you again to Ken. Hopefully some of you here will be inspired to apply now. So I thought I'd just finish off by talking about how you can do that. So the application process is fairly simple. You submit an application through our website. We are still accepting applications for another couple of weeks up until the 4th of December. In terms of what you need to apply, you need at least 5 years of relevant senior work experience, as well as a strong undergraduate degree. I've put a little caveat in here just to say, on rare exceptions, if you have really exceptional work experience, it might be possible to overlook the degree requirement, but generally speaking, this is an Oxford degree, so you will need that sort of academic background. You'll also need to provide some evidence of your English language proficiency if you don't come from a country where English is recognised as the main language. So if it's been a while since you did a TOEFL or an IELTS exam, you need to upload a statement which details how often you use English and in what capacity. So, if you use it in a professional context, we would like to know. I'm sure you'll all be pleased to hear that there's no GMAT or GRE requirement, so that should save you a bit of time and money. You'll need to provide a CV or resume if you like, no more than about 2 or 3 pages, and just make sure it's up to date. You also need to provide us with your academic transcripts from previous degree. And by this, I don't mean your degree certificate, I mean the breakdown of your marks and what modules you studied. So if it's been a while since you were at university, you might need to get in contact with your old university, and they might need to dig that out of the archives. You also need to provide 2 references. At least one of these must be professional. Doesn't necessarily need to be a line manager. So, if you are a CEO or someone very senior and you don't really have someone you report to, or if you're freelance or a consultant, it could be someone you've collaborated with on a project, or a client that you've delivered a project for, just someone who can really talk about your professional abilities. And then there's 2 short essays, they're each about 500 words. The first one will be about what are your motivations for applying and what are you hoping to gain from this program. And then the second essay will be about you talking about your achievements in your current role. So you submit the application online, and it takes the admissions committee a few weeks to consider your application. And then we'll send you the decision. I'm sure you'll all be pleased to hear there's no interview process, so it should be quite simple. I appreciate I kind of breezed through that, but we are holding an event in a couple of weeks where the admissions team will go through in detail the application process and give you some tips about how you can put forward a strong application. So I've put the QR code up here on the screen now if you want to take a quick picture or screenshot of that. It would be really useful to attend, I think. If not, I'm sure they'll record the session and send it around afterwards. And then, finally, please do stay in touch. If you do have any questions following today's session, or you want to find out more about the program, then here are my contact details. Again, if you scan the QR code, that will take you through to my email. I'm on LinkedIn. I'm quite easy to find. I have quite an unusual name, so it should be easy to find me. But I just wanted to say a big thank you, first of all, to Ken for leading the session, and to all of you for taking time out of your busy schedules. And just a final note to say that this session has been recorded. So if you had to fall off for a bit for a meeting or a call, we will send around the slides sometime next week. Right, so we've got about a minute left. I'm just wondering if there's any, Ken, whether you have anything you want to finish off with, any questions, or are you good?
I'm good, but I'm happy. I've been typing answers in, but hopefully I'm assuming that.
Amazing, thanks. Okay, right, well, thank you again, everybody, and yes, enjoy the rest of your day, and take care. Bye.